And then the same day, in the same transaction, we can move it all outside your taxable estate, saving your estate $12 million. Yeah, so the biggest one would be the estate tax that we haven't talked about. So the estate tax is facing every ultra high net worth individual. So let's walk through that. Let's say Kyle and your lovely wife, you guys are worth $52 million. Let's fast forward like 50 years from now.
This is
right?
fantastic.
If it was today, let's just say, so yeah, you're worth a lot of money, right? And you're like, hey, I was always taught to just 1031 and drop, right? 1031, 1031, 1031, drop. My kids get the stepped up basis. Wow, they're tax free, right? Great. Well, that's true for capital gains tax, but it's not true for estate tax. Okay, estate tax is separate from the stepped up basis. This is a common misconception. The estate tax looks over your overall estate, okay, and basically says, okay, yeah, your kids are capital gains tax free, but you're worth $52 million. As it stands today, Kyle, if you hadn't done any estate planning, and all $52 million was inside your taxable estate, that first $22 million would be exempt, but that $30 remaining would be hit with a 40% death tax. Ouch, wow. Right? That's gonna hammer your estate. That's $12 million on that $30 million. So the intent is to get that outside your taxable estate. The challenge is most of the clients we work with before they found us, they haven't been able to get it out fast enough. I mean, they've done gifting, they've done some FLPs, they've done some other estate planning, they may do some charity stuff, but they can't get it out fast enough, and they run out and they go, I still have all this money left. The solution is the Deferred Sales Trust, and this is what's just amazing. We can sell an asset today. Let's imagine it was a $30 million apartment complex that you were selling. And then the same day, in the same transaction, we can move it all outside your taxable estate, saving your estate $12 million. Okay, so we're doing a live deal in San Francisco right now. It's a $100 million client who has a $20 million sale of a business, and all $100 million is inside their taxable estate. And so on this one transaction, we're going to move that $20 million outside the taxable estate. It has to happen at close of escrow, has to have a $20 million buyer who's lined up, has to use the Deferred Sales Trust. But when all those things come together, it move it outside the taxable estate. And not only are we going to save them about $8 million in capital gains tax, but also about $8 million in estate tax, okay? So that's the one I would really encourage listeners who are ultra high net worth, or if you're a commercial real estate broker or business broker or have clients, to look at this because it's really powerful, and the 1031 does not solve that. In fact, it only has to do with the capital gains tax. We do capital gains tax plus the estate tax, which is really powerful. Also, we can save a failed 1031 exchange. That's the other one we didn't cover either. So if you're going for your 1031 exchange and it fails, we are a backup plan. Okay, so you have to use a QI company that will allow you to do both, and we have those companies lined up. So make sure that they give you both options. But we want to let you know that just in case it fails, we can be a backup plan, and we don't take up one of your positions. So we don't, and we also don't. It doesn't affect your exchange at all. You should always have it. In fact, we hear too many stories of people who say, "Oh, I thought I had it all lined up. I thought the seller was going to deal. I thought the lender was going to lend, but it all fell apart, and now I'm stuck with this tax." I encourage your listeners to be proactive and get all of this stuff lined up before they're in that position.